up, everyone? Welcome back. Second video in the fractal foundation building reading ranges videos in the second section. In this one, I'm going to introduce two new concepts. In the first one, we introduce the idea that we read the chart from left to right, and that whenever we are reading the chart from left to right, we have full ranges that we are actively looking at, and then once it is necessary to read and pull more data, we pull inside ranges and inside levels, pivots, structure to get our bias and refine that idea even more. So in this one, I'm going to be introducing two new concepts, which is the idea that we have true breaks of ranges and we have false breaks, which can be seen in multiple ways. So before we get into that, I want to explain that whenever you're looking at this stuff, it does take a while to start to see it yourself, but you will if you follow the videos top down from one to the end of the course and you stick with the group and everything else. This stuff will slowly start to unfold. Not even slowly, it'll unfold a lot faster than it would if you were trying to learn this stuff on your own without these explanations. So just trust the process and stick with it. Don't overanalyze, because these technicals, again, as I've said in multiple videos, are not shit, regardless of how powerful they can be, especially in comparison to what retail or the majority of people looking at the markets are doing, whether those are fundamental traders looking at news, looking at indicators, looking at trend lines, all of that stuff. None of that matters if you cannot handle your own psychology and understand more about yourself and be disciplined in the market. So, first concept is the idea of protected highs and protected lows within a trend or within a market. So, take from this high to this low. We go high, low, lower high, lower low, giving us this clean downtrend. Okay? Now, you need to understand, let's take the 4 stages of the market, for example, and keep in mind the price map that was shown in the first video to kind of apply to these concepts to build that understanding even more. So let's say you have an uptrend like this, okay? Now you're printing higher highs like this and higher lows. Okay, now your last break, so let's take, it's not the last break in this example, but let's just take the break of this high here, which happened here, to the top side as our example, and the idea of protected highs and protected lows, or manipulation, or not manipulation, protected highs, protected lows, or our invalidation points, the area that if price trades past, we know we are wrong, and our bias can then shift. Okay? So, within this uptrend, after this break, let's say all we see in price is that we last printed this high and now we're currently trading down in. Okay? Now, our invalidation point in that case would have been this low. So, protected low of the last break was here, this blue line being this low. If price was to trade down underneath of it, close below it with volume, because again, we look at candles or we look at price and ranges through the idea that volume is shown within the candles and liquidity or money and where it is laying at in the market at any given time is shown to you within the candles themselves. That is all you need. So let's say this here is a high volume area. Price trades under it and breaks under it with a close. Okay, that is a true break, which then we would be under the assumption this uptrend we're assuming is going to happen is now invalid, and our bias has now shifted to the downside to where we could assume price would trade up and distribute and then move lower, targeting this low. And now that we have shifted into a potential bear bias, we're under the idea that we're now potentially in a downtrend, and price could trade under that even, because in a downtrend you print lower lows and lower highs. So that is the first concept that I want to explain. And the second one is the idea of a true break versus a false break and a manipulation of the range, high or low, grabbing orders, grabbing liquidity, grabbing money to then continue in the opposite direction with your bias. So back to this example over here, this here was a clear downtrend, high, low, lower high, lower low, to then we have price trade up in, giving us this equal high. Now, notice here what happened. Did price actually break above? No, it did not. So from there, price then comes in and it begins to print lower, giving us this inside downtrend. Grabbing with this move up all of the liquidity from inside of this move down, filling up into this high volume area here to then move to the downside. Now, that is an example of a false break or manipulation of a high or low of the prior range that we were looking at, because this range here was confirmed, boom, with this break, to then test back in, grab the liquidity from all of this inside move in here, to then return back into a downtrend for that time being. The next example I wanted to show is the idea of a protected high or low being traded into, traded underneath, being manipulated, and then continuing in our bias direction. So as we came in, we printed this low. This here high was then broken. Boom, boom, broken this high, testing back in, printing in this high, breaking above it, giving us our bullish bias. This here is our invalidation point. Price then tests back in, and notice what happens here. This is a reaccumulation, but we wick underneath of it and reject it to then continue to the top side, giving this perfect accumulation in here, giving us this perfect move, perfect play here, this rejection here, giving us that spring to then move to the top side. Now, moving on is the idea of a true break, and then as structure prints, that the protected highs and lows of that given range or that trend and the sub ranges within that overall range being held. So here we have high, test in, low, and then the sub ranges within this high to this low, boom here, broken to the top side. Let me remove some of this real quick. It's just to keep the chart clean so you don't get confused. So here was our overall range in this example, from this high to this low, and the sub ranges within that being the high that created this low here, broken, tested, broken, tested, broken, tested, broken, tested, broken, tested, broken, tested. Notice that each time we get one of these new breaks, so here the initial break, this here being that inside range invalidation point, price tests back in to then break up to the top side again, giving us a new invalidation point here. Price trades into it perfectly, wicks under it, grabbing the orders, moving up to the top side, breaking above again, giving us our new invalidation point, which is basically the same area, giving us this equal low, boom, boom. Price trades into it again perfectly to then give us our new target, trade into it, test back in, new invalidation point, new break to the top side here, test back in, new higher low, test back in, break above it, invalidation point, test back in, holds, give some impulse to the top side here, to then ultimately shift our bias after breaking under this last protected low here. Now, once that happens, this entire inside uptrend or this entire inside sub-ranges that we were looking at are now invalidated. We can be under the idea that this move has now shifted bearish on the higher time frame after this break here occurred, boom, to then continue to the downside. So again, the two concepts primarily that you need to understand are that we have protected highs, protected lows, which we use as invalidation points, and then we have if price was to trade in and give us these equal lows, such as in, or the equal highs in this example, or the equal lows in any of the examples I was showing you in here, we can still hold our bias as long as we do not get a clean break underneath of or above that given protected high or low. So yeah, that's pretty much it for this one. I just wanted to introduce the main two concepts, which is the idea of protected highs and lows, and the idea that if a level or a range, protected high, protected low, invalidation point, whatever you want to call it, is tested into but not broken, it can remain valid as long as it is not broken and there isn't large volume that shifts into the market, shifting our bias in the opposite direction. So yeah, that's pretty much it for this one. Next one, I will go more in depth with all this stuff.